Most people believe wars are won by soldiers, strategy, and courage. History tells a quieter, more uncomfortable story. Long before the first shot is fired, wars are decided in balance sheets, ledgers, and promises of future payment. Armies don't march on bravery alone. They march on food, steel, wages, and time. And time in war is the most expensive commodity of all. In this episode, we're not telling a war story. We're exposing the financial machinery that made modern warfare possible and permanent. If this deep dive sharpens how you see power, support History of Finance Decoded by subscribing. Every like and share helps us uncover more historically grounded truths. Now, to understand why war created the modern financial system, we must return to a world where governments still feared their own people more than their enemies, because the first problem was never the battlefield. Before wars became military problems, they were money problems. Before the 17th century, war finance was brutally simple and dangerously unstable. Kings raised money the old way: heavy taxation, forced loans, or outright confiscation. When taxes rose too fast, rebellions followed. When rulers borrowed and defaulted, trust vanished. Spain learned this the hard way in the 1500s, defaulting multiple times despite vast New World silver. France faced repeated fiscal collapses as wars drained treasuries faster than taxes could refill them. The core limitation was clear: governments could raise money only once. After that, resistance grew, creditors disappeared, and states weakened. Wars were short not because rulers were merciful, but because they ran out of money. Victory depended less on military genius and more on who collapsed last financially. This fragile system could not survive an age of longer, more expensive wars. The real enemy of early empires wasn't defeat, it was insolvency. Everything changed when wars themselves changed. By the late 1600s, European conflicts became industrial in scale. Standing armies replaced temporary forces. Navies required constant maintenance. Supply chains stretched across continents. War was no longer an event, it was a system, and systems demand predictable funding. Britain, locked in near constant conflict with France after 1688, faced a brutal reality. Taxation alone could not sustain prolonged war without destabilizing society. The solution wasn't higher taxes, it was time, specifically buying time with borrowed money. Instead of extracting everything up front, governments learned to spread costs across generations. This was not a moral breakthrough, it was a survival adaptation. War forced states to invent finance that could outlast public patience. Modern finance wasn't designed for prosperity, it was designed for endurance. The breakthrough came when governments realized something revolutionary: debt could be safer than taxes. Taxes provoke resistance immediately, debt delays pain. In 1694, Britain institutionalized this insight with the creation of long-term government borrowing backed by interest payments. Creditors weren't conquered subjects, they were voluntary partners. The state promised regular interest, enforceable contracts, and credibility. For the first time, lending to war became rational, not reckless. Debt transformed war from a fiscal gamble into a manageable process. Losses could be postponed, costs could be rolled forward, and most importantly, the public could be kept calm while wars continued far longer than ever before. This wasn't financial trickery, it was a structural evolution driven by conflict. Debt didn't fund wars, it made endless war possible. Interest became the quiet engine of power. By paying interest reliably, governments converted citizens and institutions into stakeholders of state survival. Bondholders wanted stability, merchants wanted continuity, banks wanted predictability. War finance created alignment between private wealth and public power. This was the birth of the modern financial state, not one that avoided war, but one that could afford it repeatedly. Over time, winning wars mattered less than sustaining them. The ability to borrow cheaply became a strategic weapon, more powerful than cannons. Britain didn't dominate because it taxed harder, it dominated because it financed smarter. And once this model proved effective, it spread, quietly, systematically, irreversibly. The strongest weapon in modern war was never the army, it was credibility. Once governments proved they would honor interest payments, something extraordinary happened. Debt stopped being a desperate act and became a market. In London by the early 1700s, government bonds were no longer held quietly until maturity. They were traded, priced, speculated on. This created liquidity, the ability to turn future promises into present cash. War bonds could now circulate through society like currency. Merchants could sell them. Banks could collateralize them. Wealth no longer needed peace to grow. It could grow alongside war. The state gained flexibility while investors gained safety. This wasn't chaos, it was coordination. A financial ecosystem formed around war finance, making borrowing cheaper the more it was used. War didn't just create debt, it made markets that thrived on it. As debt markets matured, loyalty quietly shifted. Citizens once feared taxation, now many depended on interest payments. Pension funds, insurers, and wealthy households became invested, literally, in the state's survival. Default was no longer just a fiscal failure, it was a political catastrophe. Governments learned this lesson quickly. Paying interest on time became sacred, even when cutting social spending or raising future taxes. The state's first obligation quietly changed. Bondholders came before battles, before reforms, sometimes before voters. This wasn't corruption, it was structure. A government that defaulted lost credibility, and credibility had become the real currency of power. Interest didn't buy money, it bought allegiance. Other nations watched carefully. The Dutch adopted similar systems, financing trade wars and colonial expansion through credit. France attempted imitation but struggled with credibility due to repeated defaults. The lesson was harsh but clear. Borrowing works only when trust is absolute. Across Europe, war winners were increasingly those who could borrow the longest at the lowest cost. Military strength followed financial strength, not the other way around. By the mid-1700s, war outcomes were often decided years before conflict began, in bond markets, not battlefields. States without reliable credit faded, those with it expanded. Finance quietly reordered the global hierarchy of power. The map of empires was redrawn by interest rates. This system reached its most refined form when debt became permanent. Governments no longer planned to repay principal, only to service interest indefinitely. This was not irresponsibility, it was strategy. As long as growth and taxation covered interest, the debt could roll forever. Wars ended, but the financial structure remained. Debt outlived kings, treaties, and even constitutions. What began as an emergency tool became the backbone of state finance. Borrowing was no longer justified by crisis, it was assumed. Peace didn't dismantle the system, it normalized it. Temporary war debt quietly became a permanent feature of governance. When America emerged from revolution, it inherited not just freedom, but financial lessons written in blood and bonds. British methods were studied, not rejected. The question wasn't whether debt should exist, but how it should be controlled. The idea that a nation could strengthen itself by owing money shocked many citizens, yet it had already proven effective abroad. War had taught governments something irreversible. People resist taxes, but they tolerate interest. And once that truth was learned, it could never be unlearned. The modern financial system wasn't copied blindly, it was adopted because it worked. The most powerful financial idea in history crossed oceans disguised as necessity. In 1789, the United States was free but financially fragile. 13 states carried war debts, currencies were unstable, and international credibility was nearly non-existent. This was not a philosophical problem, it was a survival problem. Without credit, the young republic could not defend itself, trade effectively, or command respect abroad. European lenders still remembered defaults and broken promises. America needed to prove it could behave like a state, not a rebellion. The question was never whether to borrow, but how to turn debt into legitimacy rather than weakness. Independence had been won, but financial trust had not. Alexander Hamilton understood something most revolutionaries did not. Debt, if structured correctly, could bind citizens to the state instead of dividing them from it.
In 1790, he proposed that the federal government assume all state war debts. The move was controversial, even explosive, yet it achieved something extraordinary. Creditors no longer saw 13 fragile governments, they saw one permanent debtor. By consolidating debt, consolidated power. The United States became legible to markets. Trust was no longer scattered, it was centralized. By owning the debt, the government owned the future. Hamilton went further. He argued that government bonds should trade freely, creating a liquid market. This allowed farmers, merchants, and bankers to participate, not equally, but collectively. Ownership of debt became ownership in the system itself. Those who held bonds had a reason to support the government's stability. Default would now hurt not just elites, but a wide financial class. This wasn't idealism, it was incentive design. The republic's survival was quietly linked to investor confidence. Loyalty was engineered, not demanded. Critics warned that permanent debt would corrupt democracy. Hamilton did not deny the risk. Instead, he reframed it. A government trusted by creditors could act decisively in crisis. A government without credit would collapse under pressure. History, he argued, had already chosen. Britain had proven that debt, managed carefully, could outlast wars and rulers alike. The question wasn't purity, it was endurance. In that framing, debt stopped being a burden and became infrastructure. What looked like weakness was actually resilience in disguise. By the early 1800s, the pattern was set. War created urgency, debt created capacity, interest created loyalty, and credibility created power. The United States did not invent this system, it inherited it, refined it, and normalized it. From that moment forward, modern states would be judged less by gold reserves or armies, and more by their ability to borrow calmly in chaos. The financial system born from war had become permanent and invisible. The most durable empires were built on promises, not cannons. By the mid-19th century, the war finance model had matured into doctrine. Industrialized states no longer waited for emergencies to borrow, they planned for them. Railways, navies, and colonial administration were financed in advance through bond markets. War was no longer a disruption to finance, finance became preparation for war. Governments that mastered this rhythm could mobilize faster than those reliant on taxation alone. Speed, not size, became the decisive advantage. The battlefield was now funded before the first shot. The 20th century accelerated everything. World War I pushed borrowing beyond historical limits. Governments suspended gold standards, expanded credit, and normalized inflation. What began as temporary emergency measures quietly became permanent tools. Citizens noticed higher prices, not the architecture behind them. The true transformation was institutional. Central banks gained authority, debt markets deepened, and fiscal restraint faded. War had rewritten the rules of money, and peace never reversed them. Emergency became precedent, and precedent became policy.
After 1945, a new global system emerged. Bretton Woods formalized what war had already proven. Stability required coordinated finance. The dollar replaced gold as the world's anchor, and U.S. debt became the safest asset on earth. This was not accidental. It reflected credibility earned through war financing, industrial capacity, and institutional trust. Power was no longer measured only in territory, but in whose liabilities others were willing to hold. The strongest nations sold promises the world believed. Today, this legacy surrounds us. Governments borrow not because they are reckless, but because the system demands continuity. Pensions, banks, insurers, and foreign reserves all depend on sovereign debt functioning smoothly. Default is unthinkable not for moral reasons, but for systemic ones. Inflation absorbs strain quietly. Debt expands patiently. War may no longer be constant, but the financial logic it created still governs peace. The war ended, the system never did. Modern finance did not emerge from free markets alone. It was forged under pressure, refined by conflict, and stabilized by repetition. War taught governments that money could be mobilized faster than consent, and debt could unify interests more effectively than force. Understanding this does not make the system disappear, but it explains why it persists and why it feels invisible to those living inside it. Once you see the pattern, the present stops looking accidental. War shapes more than borders. It shapes the systems that decide who gets credit, who carries debt, and who holds power long after the fighting ends. When you understand how modern finance was built under pressure, today's inflation, borrowing, and crises stop feeling mysterious, they become predictable. If this episode added clarity to how you see money in history, support History of Finance Decoded by subscribing and sharing this video. Your support helps us continue uncovering the real origins of the systems that still govern our lives. We'll continue this journey in the next chapter.